Hi, everyone, and welcome to today's webinar. As always, I want to make sure that you can hear me and you can actually see the slides. So if you can raise your hand just to let me know that you can hear me and that you can see the slide, that would be greatly appreciated. I'm going to hope that you can hear me and see me or see the slides. So anyway, as always, this webinar is being recorded and will be placed on the website within a couple of days. If you have any topics that are of interest to you that you think will help you, please let us know so that we can go ahead and create a webinar for you. So anyway, let's get started. We're going to talk about buying the business with no money down. So I want to talk a little bit about the criteria of deals. This is just a quick summary of what Mike is looking for. He's looking for businesses that have been in operation 2 to 3 years or more, businesses that have gross revenues of $1 million or more. They can be in the following industries: manufacturing, distribution, retail, not brick and mortar retail, but online retail, technology, and service. The business can be outside of the U.S., but you want to make sure that the English is the primary language used in the business. The business can be online or offline. He doesn't want any restaurants or franchises. That also holds true for assisted living. There has to be it has to be really unique for him to be interested in an assisted living facility. Optimal qualities are that it's a sales or market business, that it possesses some exclusivity or uniqueness in product design or service. Products or service has a margin. Product has a built-in demand, and the product or service cannot compete solely on price. Cheapest is not always best. Again, these are the criteria for Mike to actually work on a deal. The things that are in the deal vault have to meet these criteria at the very least. So if you're looking at things in the deal vault, that's what's going to be, these are the kinds of companies that you'll find. If you find a company that does not exactly meet this criteria and you're feeling comfortable after you've done your due diligence, you can go for anything you want. This is what Mike is interested in. And also, if you're pulling companies off the deal vault, remember that somebody has placed that information in the deal vault. They've done the research. They will be expecting a piece of that business. So you have to make sure to talk to those people and make sure they're included when you're doing your negotiations. This is the online free valuation tool. I recommend that when you find a business that you like, most of the postings do have some financials in there. Make sure that you plug in some information to find out if the asking price for the business is even in the ballpark. Many times when business owners are looking at the value of their business, they're thinking of it in terms of what is it that I need to retire on, and they don't really think about what are the components needed to value a business for a particular amount of money. So this is something that has been a very helpful tool and can be used in your negotiations. So again, this is an online tool that's available for free, and you punch in information that you have about the business, and then it will tell you, based upon the information that you have entered, what that business is worth. So when we talk about this business flipping program, there are some key elements that you want to think about. You want equity with as little cash down as possible. So what we're trying to do here is we're trying to get companies for as little money as possible, but to actually get ownership of the business. And there's many ways that you could actually structure the deal for you to be able to do that without putting down very much money. So we're going to talk about some of those things today. You also want to let them know that you're not salespeople, you're not affiliates, okay? You're actually investors in businesses, that you're there to improve them, to improve the value, to improve profitability. You're actually going to solve problems that are going to increase the value. You also want to ask them if they want to sell their company for more than it's worth today. Well, hold on a minute. More than it's worth today. So, the thing is that you have to find out what is the issue with that business, because you might be able to do some very simple things that increase the value. So, structure a deal, you have some milestones where if you hit those milestones, if they're willing to wait to let you run that company without you having to put any money down, that's an excellent way to do that. You want to also explain how you can triple a company's profit in 12 to 18 months. You can, when you look at a company and you start doing your due diligence, you want to start having your eyes wide open and your mind wide open about what are the things that you can see that this owner is missing that could actually help you to increase profitability, bring in more customers, etc. The other thing too is that you only work for equity. When we talk about being performance-based, you can actually set metrics that if certain milestones are hit, that you'd basically get payouts at that point. You also want to explain that you have teams of experts that can help solve their problem, and they must also understand that your goal is to eventually sell the company, and that they will get a smaller piece of a bigger payday. And what we mean by that is that if you increase the value of the company, I have a friend of mine that always says, do they want to have a bite of a grape or the bite of a watermelon? So it's like, if you're going to be able to increase the value, I mean, if you have like 1% of a company that's worth, multi-million dollars, that's going to be a lot more than, 1% of something that's under $1 million. So those are some things to consider. So you really want to ask, I'm going to say there's 6 questions. You want to ask them, why does the owner want to sell? You have to get some idea of what the motivation is. You also want to find out if this is the additional question that's not listed here, but if they have attempted to sell it before and they had a buyer, why didn't it sell? What was the reason that things fell through? You need to get information about any other deals that had been negotiated. Is the seller willing to provide financing? You want to find out, are they flexible? What are they looking for? What are they trying to achieve with the sale of this business? It might just be that they don't have anybody to pass the business on to. They want to get to a point where they're retiring. You got to find out how flexible they're going to be, and you can find out some of that information based on asking these questions and having a deeper dive of a conversation. You want to talk about in terms of what do they see as the potential for the business? What is it? I think you also want to find out, why did they start it in the first place? And then, is the company profitable? And you want to make sure that you back up. If most of the time they'll tell you it is profitable, make sure you validate that by looking at the financials. And then, as I was saying, will the seller take a smaller piece of a bigger pie later? So once you've improved the profitability of that company, they might want 10% of something today, but if you can increase profitability, that could actually equal a lesser percentage of a larger number. So those are just some things to consider. The other thing about these two, in terms of why does the owner want to sell, what is their urgency to want to sell the business? I use an extreme example. One of the things is if somebody's just putting their toe in the water, it could be a very long process. There could be a lot of negotiations going back and forth because they're going to be very set in their ways. I mean, if you have somebody that has an urgency to sell, and this is an extreme example, like if you ask an owner why do they want to sell, and they say that they only got 3 months to live, that's a motivated seller. That's somebody that's going to make sure they get the deal done. They're going to make sure that they move it through. They're not going to sit there and cause delays. So that's why it's really important for you. And you also want to find out, do they want to remain involved in the business? That's another thing that you can use in your negotiations. So these are, I want to talk about some rules for you, the buyer, okay? These are some things that you need to consider as part of the due diligence as well. You want to take the time to look at the business market in your community and pay attention to the businesses that interest you and that you feel that you could run and that you would be pleased to own. This is the thing. It's like everybody has things that they're passionate about. You want to make sure that you find something that you're going to enjoy, something you're going to get excited about. You want to make and you want to understand how much risk are you actually willing to take on any kind of a business that you're going to actually purchase and run. You also want to take the time to visit personally with a business broker that has businesses listed in your market and form relationships with these people. I've said on previous webinars, not all business brokers are working in your best interest or the seller's best interest. They're just out there to make the money. Find the business brokers that really want to add value. Find the ones that understand that it's necessary to share information, to be collaborative. If you're not working with somebody like that, fire them and get a new one. There's plenty of them out there, and many of them are very professional, and they really care about adding value to their customers. take the time to look at and visit incognito any business opportunities you are in that you're interested in. You want to get a feel for the business. Walk in like a potential, customer. Don't let them know. That kind of do some intel, kind of see how the staff deal with customers, see what the experience is like, see how they deal with certain situations. So, go in there and actually observe and see how that business is being run. You want to make sure that you do meet personally with the seller. You want to get an idea. You want to get to know them. You want them to get to know you. You want to find what their story is. You want to learn as much about them as possible. You want to hear, this was something that was very important to them that they built. You want to hear their story. You want to hear what motivated them to actually do this. You never do any face-to-face negotiating with the seller on the first visit. I know sometimes people get very anxious with that and want to get going on doing deals. You want to make sure that you have a really good sense about what's going on with that business, that you understand where the pitfalls are. You want to make sure that you're in there eyes wide open. So, this negotiation phase, you want to really think it through. I actually think that you can talk about some very high level things, not on the first visit. This would be after you've, gotten your information. And when you start thinking about how you want to structure your letter of intent, you want to make sure you get everything in writing. You want to make sure you cover as many bases as possible, because the more upfront you figure out, the less likely you're going to have hiccups in the process. And if everybody's going in at all times with eyes wide open and there's complete clarity in the situation, it's going to prevent, now there's no way to prevent every problem, but it certainly is going to, lessen the, where there's some disconnects with, an understanding of what the two of you are trying to do. You should already know, if you like the business, and you should have preliminary financial information. Okay, so when you're in there and you're ready to sit there and think about, making an offer, you should like it, and you should also have some idea on the numbers. You also know what you need to make a year to provide a minimum lifestyle for you and your family. You want to make sure that you can sustain yourself and your family. You don't want this to be a drain on you. You want this to actually be something to help you achieve what you're wanting to achieve in terms of lifestyle. And the other thing too is never, ever, ever start with a full price offer. As I was saying, most business owners are picking numbers out of the sky. And, they're looking at it as, okay, they've put their life into this. They've put a lot of hours into this. They look at this as their retirement vehicle. I can tell you that a lot of business owners don't have a clue as to what is required to get a good value for the business. Many times they think just because they've put in all that blood, sweat, and tears, and they've have customers and they see it as a perceived success, there are certain things that need to be in place for the business to be valued at a certain number. There has to be processes in place. There has to be the ability to run the business without the owner being involved. There's all kinds of things that need to be looked at. So I never, ever, ever start with a full price offer. You always want to make sure that you go with a price that is fair, and then you can always negotiate the details and try to come to a place where both of you are going to feel it's a win-win situation. Never take yourself out of cash with your down payment. So that means take your lump sum of your whole life savings and put it as a down payment for the business. You want to make sure that you've got access to capital. So if you need to invest in the business, if there's things that you need to do to help to grow that business, that you're not going to be without any type of capital to actually do the kinds of projects that you want to do. And the other thing is, you never want to pay cash, all cash at closing. That's going to put you in a position of weakness. You want to make sure that you get some skin in the game from that seller. And you always want to see if you can at least get the seller to finance at least part of the purchase price. The other thing too is that in the past we've had webinars where we've talked about some lending options, and I actually, SBA lenders will look at if the seller will finance a piece of it that could be used as a down payment for an SBA loan. So that's just something to think about, and that might be something that will be attractive to the seller, because if he's going to be able to be in a better negotiating position if he's willing to finance at least part of the purchase price. Any questions so far on this? David, I see you're the only one here. I'm happy to open up this phone line, although your phone is red, so I don't know if it's going to work. I'm going to go ahead and see. Okay. David, are you there?
Yes, ma'am. Can you hear me?
Yeah, I can. That was weird because the phone was like red. I didn't think you were going to be able to talk on that.
Okay.
Anyway. So stop me at any time. I figured this was because of our conversation that you were looking for some ideas on how to structure these deals and what you can do to negotiate, these no money down types of deals.
Sure.
So that's why I decided to go over this topic. So do you have any questions of what we've covered so far?
Oh, not so far. That's pretty basic.
Okay. I mean, since you're the only one here, we're going to go ahead and, I'm just going to have you be part of this conversation. So, so make any offer contingent on the following. I mean, you want to make sure, and I can't stress enough, the more detail you have in that letter of intent, the more that you talk about with this seller in advance of you actually putting together, like you got to find out what they're willing to do, right? So you want to make sure that everything is in writing in your letter of intent. So for example, you want to make sure that there's a buyer review and approval of all the finances of the business. You want to make sure that you really understand the financials, that you understand, that you've covered and you're comfortable with it. You want to review. You want to review, the terms and conditions of any leases, any kinds of contracts that they have. You've got to be able to review it, understand it, and make sure that it can be transferred over to you. Okay.
Right.
You want to make sure that the seller is actually going to train you and kind of have a transition period. Now, I will say this. Sometimes the owner is the issue with these businesses. Sometimes the reason the business is no longer profitable, sometimes these owners, they don't see anything anymore. They've gotten blind to things that might be obvious to you. If they are the problem, but they have staff that's really important to running the business, you want to make sure that they help to transition that management over to you, right? So you want to make sure that everybody's bought in and everybody is comfortable with the scenario. So you want to make sure that the seller's there to help you make that transition, okay? You also want to make sure that there's an you don't want this, the person that's selling to go out there and then compete against you. So you want to make sure that there's an acceptable non-compete agreement, that both of you are in agreement there and that they've actually signed it. I would get an attorney involved on that. Okay. Right. And the buyer being able to obtain any necessary financing at acceptable terms to the buyer. So, I mean, that's something that you want to be contingent on as well, because obviously if you don't get whatever financing you need, I mean, you're not going to want to be locked in on buying that company. So you want to make it contingent on you being able to find the necessary funding to actually purchase that business, okay? So don't ever just say you're going to do it and then all of a sudden things fall apart and then you don't have any money to actually buy the business. So you want to make sure it's contingent, just like a house, like, it's contingent on you being able to get a mortgage, same kind of deal here.
Sure.
Okay. You want to make sure, and this one's tricky because it's like you really have to have a good understanding of what is the necessary equipment. And this is the one I was talking to you about that tool and die company I was working with, where they had all these this equipment that was sort of hodgepodge together. They considered it back in the day as custom, state of the art. Well, now it got to the point where you can't even find the parts for these machines, right? They'd be better off buying new machines. So make sure you have a good understanding of any equipment that's necessary for you to service customers. And if anything is not in good working, or I would even check to see if it requires parts and stuff, like how old is the equipment and how difficult is it to get it repaired and to actually find parts for it, because that could really cause you issue if you don't know that information.
Okay.
Okay. The other thing too is you want to have a normal level of sellable inventory at the time of closing, because the worst thing that could happen is that they clear out all their inventory and you're stuck with not having anything to, like, if you need inventory to sell to customers and all of a sudden you're out of stuff and it takes 3 to 4 months to get something, you're going to be in big trouble. You won't be able to continue to service the customers because you don't have enough inventory. So you want to make sure that everything's stacked up the way you need it so that you can service the customers without them feeling any impact. Okay.
Mm-hmm.
Any questions on that?
Not yet.
Okay. Now, the seller financing, there's some ways to position this, because obviously if a seller is to finance the business, I mean, that's putting some risk on them, right? So it's like one of the advantages to the seller, if they do seller financing, is that if they're willing to do that, they're probably going to have a little bit more control in the negotiations in terms of the price that they want. Because, I mean, this is something that it's going to benefit both of you, but it also puts him in a position where if he's helping you, then I want this amount of money. But make sure it's still within your valuation. So,
Right.
you know, and again, as I was saying earlier, you can, if they're willing to finance part of it, the SBA loans will actually look at that seller financing as they'll take that as the down payment.
Okay.
That was something I just learned last year. So, so that's something that I mean, I think that now the only thing is that you have to be careful, because if you're doing like SBA lending, depending upon how you're structured and everything, you might have to put a personal guarantee on it. I'm not sure. You'll have to see how that goes. I mean, again, if you've incorporated yourself and you've already built credit history with Dun & Bradstreet, you could actually have the corporation be the one that gets the SBA loan. If you don't have a corporation that's been in existence that's already kind of getting a credit rating through Dun & Bradstreet, you might be asked to do a personal guarantee. Okay, and of course we want to stay away from personal guarantees.
I see. Would you repeat what you said a minute ago about you just learned this about the SBA loans?
The SBA, I had this was somebody that was a speaker. It was someone I was really surprised, because I didn't think SBA lenders would look at seller financing as a down payment. You know, they like to have a certain amount of money down and all that. They were saying that if you can get the seller to finance even like 10, 15, 20%, they'll think of that as the down payment, right?
Mm-hmm.
And then they'll provide you the balance via the SBA loan. And of course, the SBA loans they're guaranteed by the government, so it's, you know, there's still risk for the bank, but it's lower risk, right? So that's another option. So the more, so if you can't, go ahead.
So I'll just make sure I understood. So the SBA would pick up the payment portion and then the carry back the note.
But they would look at the seller financing. They would treat that as a down payment. So instead of you having to pay cash for a down payment for the SBA loan, they would consider that the down payment and then fund the rest.
Okay.
So, for example, if a business was being sold for $100,000 and the seller was willing to finance $20,000, then they would consider that if they needed a 20%. I don't think it's 20%. I forget. I don't even know what the percentages are anymore. If they needed 20% down, that would cover the 20%, and then they'd fund you the $80,000. You know what I'm saying?
Okay.
That was something they needed as a criteria for you to even go through the process. That's a possibility.
So in that case, I would need to come up with $20,000, and they would fund the rest.
No, what I'm saying is if you got the seller to finance you $20,000, which then you would pay back with potentially revenue from the business, or however, like if you're making money on the business, you're going to make your payments to the seller, right? Well, however you structure that, and you could even make it where, okay, you can take the payments out of this revenue. I mean, you decide how you want to structure that. So that's one way to avoid having cash out of your pocket, because the seller is going to finance it. You'll arrange some kind of payment method to that seller, and then SBA will give you, you know, the balance of that. And then, of course, you'll have to make your payments on the SBA loan, however you're going to do it.
Okay. I think I see. And
you're going to hopefully do it. So you're hopefully going to get it from revenue from the business, not out of your personal pocket.
Right. Well, if an SBA, I mean, I'm usually thinking of an SBA loan as usually funding the majority, but in this case, you're talking about basically using the seller financing to front the cash for the down payment through the operation of the business, and then the SBA kicks in for the remaining.
The rest. Correct. Because you know, they're always looking for, and I forget, 20% is high. I don't think they require 20%. I don't even know what they're requiring these days. You know, but they do want a down payment, just like on a house when you're doing a mortgage, you have to put a down payment down, right? So instead of you coming up with money out of your pocket, if you got the seller to finance the percentage, at least that, right? Then that would be the down payment, and then they would fund the rest. You see what I'm saying?
Right. What about the reverse? I mean, pretty good if you have really good credit, for example. Is it pretty good probability that you could get an SBA loan for, say, just the down payment, as long as That's basically like the 15, 20%,
so you're
whatever they require.
So you're saying for the seller would finance the rest? Yeah, I mean, you could do that too. And there's
totally.
other alternative lenders out there. In fact, I don't know if you were on the call when we had Cindy Klein on. She actually worked for, when they do it against the inventory, they do it against the accounts receivable. Right. So, I mean, there's all kinds of things out there that you could utilize, where you wouldn't have to take money out. And there are some people who actually prefer, because even though her interest rates appear high because they would be spread out over time. I mean, the way this works is that if it's on your receivables, they'll actually collect on the receivables. And if they're having success collecting the receivables and getting their money, the percentage of the interest rate that you would have to pay because you had borrowed it for such a short time is not, I mean, depending upon how quickly they collect, it might end up being cheaper for you to do that kind of alternative lending than a traditional type of an SBA. You know what I'm saying?
Right. Okay.
So you'll have to look at these on a case-by-case basis. You'll have to see where the potential is. If you've got a business that you're billing customers, and actually a company like that can actually help you collect, that might be an asset for you. That might be something great. You might like that kind of a setup, and then they'll always make sure you have cash flow and stuff. You know what I mean?
Right. Mm-hmm. Okay.
So there are some people that actually choose to do that all the time because they don't have to do collections, and then the amount of interest that they're paying, even though it's a high interest amount over time, because they're getting paid back so quickly, it's not as high as you would typically find in even a traditional bank. You know what I mean?
I'll say.
Okay. Now this is a unique thing. This was something I discovered, and I have not checked. You would have to check with a tax, an accountant that does taxes and things like that. And you might even want to talk to a wealth management expert. You know how when you leave a job and then you roll over your 401k into the new corporation, wherever your new job is, right?
Right.
You can actually take your existing retirement plan, and if you create a new plan for your new corporate or your new company that you're going to be working with, you can actually use your existing money and you can actually use it in the business.
Right, because that's self-directed at that point.
Correct. So it's one of those things where, and now I don't know what the tax implications are. I'm certainly not a tax, accountant, but this is something that is another option. And I don't know if the laws have changed to prevent this now. You might want to check into this, but this is another way.
You can still do it. I just actually bought some cryptocurrency. I did actually a rollover. What it was a direct transfer. But it was from a Roth and conventional or traditional IRA, but just a regular transfer. But I think these are just the same. I'm not a CPA. That's my disclosure, I guess. But that's my understanding is you can purchase real estate, you can purchase art. I mean, any asset, as long as it's self-directed, you can buy it.
Right. Well, this is like you'd invest, like you'd roll it over into the new corporation, and then now your new 401k plan will purchase shares in your business.
Right.
Okay. So this one's a little bit, this isn't, people don't usually think of it this way, but you can use your 401k for your business, and this is one way to do it without getting taxed on it.
Sure.
But you're going to have to, you'll have to check now because I don't know if the laws have changed or what the deal is. So this is something,
right.
This does exist. People have done this. So this is another option.
Right.
Okay. The other thing, I like this one, this is revenue sharing. So you basically negotiate with that owner. Like if they don't need one lump sum, they're fine to share in your revenue. Like you can say, okay, I'm going to improve this business. I'm hoping to hit, this revenue or this profitability by this time. If I do, I'll give you X% of the revenue, right? So they'll get money over time. And so you could actually set this up that, okay, within a certain time frame, I'm going to give you this percentage of the money up to whatever the price is that you guys agreed to. So you could actually do it over time on future revenue.
Is it kind of like a partner for growth model?
Well, I don't, it's like Mike in their terms. I don't know what their newest, latest terms are. This is basically the seller agrees to a percentage of revenue that you're bringing into the business. And this is what we're talking about. Do you want a bite of a grape or a bite of a watermelon? If you're saying you're going to get X number of X percentage of the profit, right? I mean, it's like if you can improve the profit margins. So, I mean, if today their profit margin is 15% and you negotiate 1% of 15%, but now you figured out a way to get 30% I mean, so, and if you keep it to that same percentage, then they're going to get more money because, you know, it's a higher profit margin. So if you figure out ways to actually increase profitability, you know, they'd be better off getting a percentage of something where you've increased the profit margin. So you can negotiate that as well.
We both share in the bonus, yeah.
Correct. And so the thing is that I'd be careful with this, though, because you want to make sure that you hit milestones, right? So, like, for whatever reason, if you don't hit it by a certain time, you know, you'll have to figure out what do they get it? Don't they get it? What happens if things drop? You know, you want to make sure you protect yourself. So you want to negotiate it in a way that it's tied to some kind of milestones that you both agree to. And if there is anything that could happen that could impact that, you want to make sure you cover yourself on that too in the negotiations. Does that make sense?
Right. Mm-hmm.
You don't want it to be a guarantee, right? Because you want them to share in, you know, if there's peaks and valleys, you want them to you know, deal with the valleys just like you are. You know what I mean?
Exactly.
Right. Using the seller's assets, we've talked about this, you know, where if they have inventory, if they've got property, if they've got, you know, I mean, land, whatever, I mean, you can actually use the seller's assets as part of the, you know, part of the negotiation to buy the business. So there's ways that you could, yeah, that's one thing. You could also, you might be able to lease inventory. I don't know. You know, there's all kinds of different ways. I found there was one idea that Mike had actually talked about in one of his boot camps where somebody worked a deal with one of the distributors that the seller was using, and it ended up that they ended up somehow they worked the arrangement that instead of them actually leasing equipment or having to buy equipment, they had some kind of an agreement in place because they were making referrals to have others buy it, so they were getting it for free. So there was really, you can get really creative with some of these things. So, and especially if it's an inventory, if you've got suppliers that you're buying from, you can work out deals with them too. So you can work out, and those might be ways that you can actually increase profitability as well. So you might be able to find a way to utilize the inventory property, you know, whatever, to get creative in ways to have them be revenue generators that then you could use that as part of your negotiations.
Okay.
Okay. You know what? I don't know why I have this in here. I mean, this is you know, co-ops are becoming more popular these days. And the way this works is you could have a co-op, and I guess that's what this Business Mastery University is. I mean, you have people, like-minded people working together to actually buy a business. You can get a group of people that are wanting to invest in the business with you, you know, whether that means with talent, whether that means with the other thing. And this is the other thing where it comes in handy is that smaller businesses now, in order to compete with the big box stores, they're putting together purchasing groups. So, for example, you know how it is when you deal with certain suppliers, there's volume discounts. So if you bring, you know, 10 companies together that are buying this particular supply or this you know, particular product, they buy in bulk together. Right, and they share in the expenses, they share in the risk. There's a lot more stuff going on co-op in small business than I've seen in the past. So this isn't, a lot of companies are doing this to compete with the big box stores so that they're also able to get the discounts, So they're in the risk, you know, of making those purchases as well as gaining from getting those discounts because they're buying as a group. So that's something that I'm seeing more and more of. That more small businesses are acting in this way. And you could actually do this even to buy a business. You could build your team of people, right? And then if there's certain things that need to happen, you could actually negotiate that they get a certain piece of the equity of the business in exchange for services that they could actually provide to you to help grow the business.
Right.
You know, you could do, or if they want shares in the business, I mean, that's another thing. You could have a group of people, they don't even care about what you're doing, they have faith in you, they're just willing to give you a certain amount of money to invest in this business, and then they'll be looking for the return at the end. So I mean, you might have people that don't care anything about the business, they just want to make an investment and then get a return at the end of that. Okay.
Right.
Okay. Using employee stock ownership plans, you'll need to see if that's one way to buy a business, is you can actually have the employees buy the stock of the business. Now, there's different kinds of ways to structure these employee stock ownership plans, and there's certain rules that follow through on these now, because there's many different ways that you can set, but this is another option. You could actually get the employees to pick up and buy stock in the company. Okay, right. So this is another way that you can do it without having to sink your own money into it. Have the employees invest in it. You know what I mean?
Sure. Mm-hmm.
But you'll have to think about how you want to structure that. That's going to be a win-win for everybody. Okay?
Right.
All right. Leasing with an option to buy. So, I mean, you could basically lease the business on a monthly basis, you know, and take a portion of what it is that you're leasing towards the purchase price. That's another thing you could do. So, you know, if they're not in a hurry to get out of it and they're willing to kind of watch what you're doing with it, I mean, you could sit there and lease it from them, and then, you know, take a percentage of the money that you're spending on leasing the business and use that towards buying the business.
Okay.
You know, just so like a lease option on a house.
So that would work if a buyer's motivation. I'm trying to just think through this. When would that work? Perhaps a buyer is just not selling. They've got a company that's just not selling.
Right.
And you say, hey, let me just show you what I can do, and you step in and increase, you know, sales, bring your team in or whatever, and you're kind of like you said, it's a lease with an option to purchase
you're renting
later.
the business, you're renting the people, you negotiate what that means in number. You can negotiate to take a part of that rent and put it towards the down payment. I mean, you can set this up any way that you could also set it up to say, okay, I'm going to rent this business from you until I hit this milestone, then with the profits we've gotten, then we'll buy the rest of it. You know what I mean?
Okay.
Does that make sense? You can structure this many different ways. But this is
like
another thing.
For size, because you may not like it. And
here's the thing, though. You got to be careful with this, because it's like what your example that you said. If a person can't sell their business, why can't they sell it? What's wrong with it? What's going on with it? You know, you need to find out what that's about.
Right. Or maybe there's some questions you have, and you know that the seller is probably not going to be totally open and honest. Like I'm looking at a medical company right now that's an e-commerce company, and I'm arranging a call. I'm waiting for the financials. I just talked with the broker today, so I don't really know enough to deal with it. But he did send me a sheet, a little bit of information, and I know that the company, he actually sold it back in 2014. The company had it for 2 years. The company defaulted on the payments because he took back a note. Mm-hmm. And so he's had it for this past roughly just over a year. And so it's not selling. So my question is, you know, why did they default, and why is it not selling, and why are you selling, you know, basically. So it's a lot of risk, and I don't know the details right now, but I'm just thinking right now, something like this is a way to put your toe in the water without committing.
Sure. And you know what? Actually, I'll give you an example. I have a real life example that I experienced with this. Not me as the person wanting to buy. I have a boat, okay, and I have it at a marina that is also a bar restaurant. They got music and all this other stuff. There were the first. I've had my boat at this place for the last 10 years. The first 8 years or 7 years, they had a person that was hired that was totally dedicated to running the marina. That's all he did was the maintenance on the boats, mechanic services, in and out services. They hired an employee that was completely responsible for that piece of the business, nothing else. Okay, that guy leaves. Right now, there's a huge void. They got nobody to do the servicing, take care of the marina, or any of that stuff. They find these guys that basically are taking the marina portion of the total business, and they now are renting the space, right? They're renting the facilities. They're servicing the existing customers, but they're getting the money, but they have to give a small percentage to the owner. Does that make sense? Now, I don't know the exact terms of it. We were locked in for 2 years. Right now, what ended up happening is they ended up having a huge disagreement, and it never went through that they bought it. They were going to buy that piece of the business. They never did. So, but they were leasing it for 2 years. They actually paid for, the use of the property. They got the customers. They had to give a certain percentage to that owner. And then after 2 years, they had the option to buy the business.
Okay.
So that never happened, but that's how that was set up.
I see.
So it was interesting because they collected the money. They did everything. It was as if it was their own. They had the property, and it came with, because there were already people in that marina because they were used to being there. Like I got just kind of, I didn't even realize these guys took over and like, yeah, we're doing it now. We're gonna, we're responsible for it. This is our own business. Blah blah blah.
Right.
2 years, we're gonna buy it. But we're gonna do this. We're gonna do. They were telling me all the stuff they were gonna do. So so they basically paid that owner of the whole thing for using the property, and then they brought in their own mechanics. They brought in additional customers, etc. So that's how they structured it. Okay. So you're right. It's kind of a try it and buy it kind of a deal.
Yeah.
So anyway, so if that's something that looks like it might be an opportunity, that's I'm already done. Okay.
Sure.
Oh, it is already 6:40, huh? Yeah. So these are just some ideas. Yeah, it's just us.
Yeah. This is a question on there's like 29 questions on Mike's site, and the part of this you already hit, the questions to ask sellers. This is the 29 primary questions that are on his site, and number 18 reads this, and this kind of goes into the Partner for Growth model, which is, the way I understand it, is simply using bringing your teams in, the teams that either you have or primarily if you're starting out and don't have your team developed, using Mike's teams or whatever, and they're paid by out of the cash flow of the business, and I am actually taking a percentage of equity in the business. That's the way I understand it, but all the details I don't know. But this is the question. So number 18, it says, is the owner open to trading equity for our value-added skills and resources?
Yep.
We don't take less than 30% of whole or less than 50% of value added. Is that okay? So 30% of the whole or 50% of the value added. So I'm just trying to get my arms around that and figure out exactly what that means. So they're talking about
So what they're talking about, are they willing, if you have a plan to increase the value or revenue stability or whatever, are they willing, instead of taking money, would they be willing to give you equity in the company for your skill set, right? For what you're going, what you're actually providing. And you don't, so it says here, you don't want to take less than 30% of the whole or less than 50% of value added. So I guess what he's saying here is, what is the value of the resources that you're bringing? And so, or less than 50% of that, because, he's looking at if you're going to be adding a certain value, you're trying to put a price tag on your services. So, I mean, you could basically, and I don't understand what he means by take less than 30% of whole or less than 50% of value added. I'm reading this as, we're in this together. The way I would do this is that what is the value of my services? What do I typically charge, for these services to provide marketing or to provide, systems, operations, whatever. Yeah. Security or whatever. I mean, the way I would look at it is, if you're willing to trade, I'm thinking he's like, don't take less than 30% of, because that's going to be a negotiating thing. If they're willing to take your services over money, because cash is king, right? So, in fact, for example, like when I was president of NABO, we used to say that if you wanted to provide in-kind services, like a lot of people would come to us and say, we're going to give you our services. It was a service that was of value to the organization, but because it wasn't cash, if you wanted to have a $5,000 corporate partner level, you had to give 10,000 of in-kind. So you had to double the amount of what you were giving us because it wasn't cash. Do you see what I'm saying?
Okay. Right.
So I guess he's saying they're always going to negotiate. Well, you're not giving me cash, and I don't know if your service is really going to do it. So he's saying whatever your value is of that service, like if you charge $100 an hour, because we're not dealing in cash, or you want a piece of equity. I guess he's saying don't take 30%. That would be the least amount, is 30% of $100, or less than 50% of the, like if you're adding, if your services is going to increase revenue by $1 million and you have proof of that and you have metrics of that, I guess he's saying that don't take 50% less of what that value is that you can bring. Does that make sense?
Yeah. Yeah.
So for example, in my example with NABO, if you did in-kind services towards your payment, we made you double it.
Right. Right. Because it's kind of a barter system.
Yeah, but it wasn't, because cash is king, right? Cash is usable right away and everything else. Services aren't always usable, right? You might see value in it, but it might take a while. So it's like we always said, if you're not going to give us cash and we have to vet that it's a service that we really are going to use that we feel adds value, you're going to have to do double the service to get this cash value. Right.
It's a liquidity question.
So that's what he's talking about.
Yeah, I see. Okay.
Okay. Does that make so you'll negotiate that, right? Because they're going to say, well, wait a minute, you're just giving me service. How do I know it's going to be of value? How much? So then if you have proof or you've got some kind of metric, you can set that up in the agreement. You can say, okay, we say that in 2 months we're going to do this, right? If we hit this, you know, you're going to give us 50% of our typical charge, which, let's make it up, is $250 an hour. Okay.
Right.
So the other thing is that, or, okay, we're going to do this no matter what. You're going to pay us, our typical rate is $250. You have to pay us, or you have to count it as percent of $250. You know what I'm saying?
Right.
So he's just giving you some parameters of different ways you can negotiate that. So if there's going to be a true value to the business and you can quantify that and you can actually measure it, you can say, okay, if we're going to increase your profitability from 15% to 50%, right, within 2 months, and we hit that milestone, then you're going to pay us. You're going to treat our services. We usually charge $250 an hour. You'll treat it as $125 an hour and put it towards our shares in the company, or towards the selling price. Does that make sense?
Yeah, it does. It does.
Okay. What other questions do you have, since we have 10 minutes here to kind of just have a discussion? That's why it's benefit to come to these no matter what, right?
No doubt. That's why I'm just really trying to get my arms around the Partner for Growth model, because it's my understanding that that's kind of what makes Security Equity Group a little bit different from a lot of the other private firms out there, private equity firms, that we can bring value with our partners. And that's and a lot of these companies, since we deal primarily with small businesses, they've reached these plateaus. It seems like I'm finding out they either they're burnt out or they don't have the skill set, or both, to get over the hump.
Right.
So bringing this to the table, I'm just trying to get my arms around exactly how that works. So just say, for example, 30% of the whole, we're talking about 30% of the entire sales price when it sells after we add value.
It means whatever you want it to mean. You're going to negotiate that, right? You're going to have to find out, what is the seller open to. These are all negotiations, right? This is all you have. So now what I take this as, it's like, okay, my fee is typically $250 an hour. Okay, what we could do is that let's negotiate. You can either give me 30% of that 200. So whatever hours I put into this, you're going to pay me, what's 30% of 250? I don't know. So whatever that number is, and then they'll treat that as that's going to be the value of it, and that's what they're going to put towards the selling price, right? Or you're going to say, okay, I'm going to do these activities. I'm going to increase your profitability from 15% to, I'm not making this up, 50% in 60 days. And if I reach that milestone, then instead of giving me 30% of my $250 an hour, you're going to give me 50.
Okay.
In value. You get what I'm saying?
Right.
So there's two different ways that you can structure this, and think about it. If you're going to increase the profitability that way, I mean, that's a huge win for them.
For sure.
Right?
Yeah, absolutely.
So that and everything, I mean, creative and find out, what are they open to? What are they open to doing? What are they open? There was somebody that I told that story about, the guy who used the valuation tool, and it turned out that the business was worth nothing, but he still wanted it.
Yeah.
He ended up, the seller was going to finance, and he was going to work there a while, and he was going to, the money that they negotiated to pay him, that was used towards the selling price.
Right.
So instead of paying him cash out of pocket right away, his paycheck became like his regular paychecks for running the business to stay there, end up going towards the purchase price.
Right. When he found out the real value, which was zero.
Right, which was zero. Right. So and so anyway, that's another example, right? But that, I mean, that was just when I first of all I said, why would you even go after this if it's worth nothing? I like it. I like every. I'm like, okay, whatever.
Yeah.
So.
Yeah. I need to go back and read some of the things that are actually on the website as far as this, I guess, letter of intents or letter of discussions. I think he called it now to make it sound a little bit.
Well, I actually did a
softer.
webinar. There is a webinar. I did one on the letter of intent and all the things to put in the letter of intent. So there's an actual webinar on that. So it's a little bit dry because we were just talking about all the things to think about, And you know how we had that checklist? I mean, that part of that goes towards things for the letter of intent too.
Okay.
You know what I mean? I mean, you can use that. We were giving an example of what are the things you would look at as you come in. That's also part of your due diligence too.
Right.
You know what I'm saying?
Mm-hmm. Exactly.
So that letter, and the letter of intent can be as detailed or vague. Personally, I think the more you get agreed upon up front, the better off you're going to be, because that's what ends up stalling these things is there's no clarity. There's no understanding of what you're going to be doing. Think through what it is that you're going to be doing. You know what I mean?
Yeah.
Think through what the plan is. Think through and clarify, okay, I need this. I need the financials. I need all the agreement. All those things we talked about at the last webinar for the due diligence, that could be all part of the stuff for the letter of intent.
Sure. I guess the more detailed you are with the letter of intent, then the more serious they know that you are.
Right. And, if you think about some of the terms you want to think about in your letter of intent, the price, the form of purchase, the structure of the purchase, management contracts, closing costs, due diligence, because in your letter of intent, you haven't finished your due diligence. So based upon our findings in this due diligence process, and here's what it looks like, right? Be detailed. Right. The representations and warranties, the broker's fees, timeline for closing, insurance, breakup fee. Like, what if you guys are halfway through the due diligence process and for whatever reason you decide to back off? Is there a breakup fee? Isn't there? Yeah, these are all things we want to talk about. What's the earnings disposition? What's the pre-closing access? You want to make sure you actually can get in there and learn about this, right? What are the special disclosures? What's the confidentiality? What's the seller's role post-close? What are the non-competes? Those are some of the things that you need to think about. Right.
It's also my understanding that, and I need to read through more detail with some of these letters of intent, some of these examples that of real deals that have been done that are in the website. It's my understanding that that you negotiate in a deal like this if you're doing, for example, the Partner for Growth model, in which you're actually securing equity in the company, and it's my understanding that not only are you getting equity, but you're also having teams come in, and the company is paying whatever on an hourly basis or whatever metrics you set up. They're paying a fee out of the cash flow of the company to grow it. I guess all that's negotiable, but that's the way I understand the nuts and the bolts of it. Does that sound right?
Here's another thing to think about too is that, if you have cash, the more cash you have at closing, the lower purchase price should negotiate. Okay.
Right.
You're going to be able, and so that's why for a seller, it's going to be more beneficial because they can get a higher purchase price if they include escrow, earn-outs, seller financing, and deferred payments, right? If you've got to come to the table with a lot of cash, then you're going to expect a lower price.
Like buying a piece of real estate, like I'll meet your price, or I'll even give you 1.5 times your price, and as long as we can agree on the terms, right?
Correct. The other thing too is, based upon your due diligence, the actual condition of the business can actually lower the purchase price too. So you want to make sure there's contingencies in there, you know, that,
right.
okay, this is the price if everything is good, and you want to list what that means to you, right?
Right.
So, you know, because if you go through your due diligence and you find all kinds of bad stuff, I mean, there's your opportunity to lower the price.
That's a really good point. So you put that in your letter of intent?
Yes, absolutely.
Yeah. I mean,
the more specific you can be about, and there is, I don't remember the exact date of that webinar, but I did a webinar where we actually put all the pieces of the letter of intent and how to structure it. We did very specific details.
Okay, I'll go back. I'll ask Patrick if he can send that to me.
And I'll actually look. Maybe that's, if you're the only one that's coming on these webinars, that's the one I'll do next time.
Okay, cool. This is good stuff.
I mean, I don't know whoever ends up on these things, right? I don't know if it's because of the holiday or what, but
yeah, I don't know either. Yeah.
Right.
Kind of
but
wild.
I mean, if you're the only one on here, you get to call the shots on what you want to hear about.
Hey, I get another free coaching call. I'm okay with it.
You get two more. You got two more actually that are part of your deal.
Yeah, I think I got.
Because I actually after we did the one, I think you had 2 or 3 more. I don't know. I forgot now.
Yeah, I have to go back and look at it too. But
and then the thing is that, I mean, if it's just you and me on these calls, let's go for it. Whatever you want to know.
Yeah, that's great. Good stuff. Well, I'm waiting to hear back from this other company we had talked about, this fabrics company. And it just drives me crazy, these brokers, that they don't send good financials. I mean, you think they are used to this, or they just try to play games with me. I mean, I'm wanting some
David, I was going to say, there's a reason, okay? There's a reason.
Yeah, exactly, yeah. I mean, wanting monthly financials to be able to see trends. You know, they send me everything kind of, 1 year at a time, and that's okay. But I guess maybe I'm asking for too much, but I wouldn't think so. Is that too much?
No, it's not too much to ask for, and it's. Can you hang on just a minute?
Go ahead.
Hold on. Like a minute. That's my daughter. She's been calling like a zillion times. So anyway.
But yeah, I agree with you. I mean, that's not too much to ask for. I mean, with the technology nowadays, it's pretty easy to spit out that information.
You should demand it, and I mean, if they're hesitating on that, that's a red flag.
Yeah, should I get tax returns up front, or just wait till closer to?
Absolutely, I would definitely get tax returns, because the tax returns are going to validate the financials. Remember, they can, unless they're audited financials, they can make them look any way they want. And I'm not saying that people do that intentionally, right?
Sure.
But they're trying to put their best foot forward on these businesses, so that I mean, they're trying to make it look as blemish free as possible to try to get a higher number for it.
Oh, I understand that for sure. I just was wondering, should I ask for the tax returns when I'm asking for all the financials, or just kind of wait until we get close to?
Here's the one thing, is that when you're doing your due diligence, you want to make sure that part of the due diligence process is you're meeting with that owner face to face, and you're going on site, you're meeting everybody, you're meeting key personnel and everything. You make that part of the deal. Even
for an online business?
I would do a Skype call or something. If they're far away. I mean, I would have a conversation with them with a Skype call.
Yeah, because this medical company I'm looking at is it's a 3-hour drive. It's not far, but it lets me get a good idea of because they actually have space they're actually renting right now to do things, and so I would have to, if I bought it, it's relocatable, even though it is online. There's equipment, things like that.
Well, I would want to see the equipment. I would want to see the operations. I would want to see the facilities. I'd want to see all that personally.
Yeah, exactly. Yeah, for sure.
So anyway, so David, I'll do the letter of intent one, for next time. I do have that already put together. So we can do that. And I don't even know which ones I'm doing for June. So the next one I will do the letter of intent.
Cool.
Okay.
Thank you so much. Good as always.
All right.
Appreciate it.
Have a good one. All right.
You too.
Bye.
Bye-bye.